Thank you very much for the introduction, Paul, and thanks to Red Rising Stars for inviting me once again, and to Mining News as well for the support of this conference this year round, and Acacia as well. It's great to see some names which I like and admire being associated with a conference which I've come to really love attending and to talking to as well. So really appreciate that. Let me just give you a little bit of a background on myself as well. I'm using a new corporate template here for the first time, and I usually have a pretty bland background there. I'm a geologist. I work for Lion Selection Group. We invest in early stage mining opportunities. And on the screen there, you see a fairly unique project. There's somewhere between 5 and 10 million ounces of gold in that hill. And that's something which we've been fairly closely associated with for some time. I'm not going to talk about that today. You'd have to hit up Lion's website if you wanted to have a look. But that's what I'm about. And because I'm presenting remotely, I'm going to have to ask for the people at the back to advance the slides for me. So if you wouldn't mind, please, Gary, thank you very much. So what I'm talking about today, spoiler alert, is the mining boom and the mining cycle. And we're actually in a fairly mature part of it, I think. Now, I don't mean that as a warning, because the part of the boom that we're in is the part that we have been waiting for so long. This is when explorers and junior miners really start to perform. So if you're a holder of that, as I am, and I suspect everybody who comes to this conference is, this is the bit that we've really been waiting for. So I've called it the sweet spot, but it's also quite an unconventional boom in many regards. So I'm going to touch on a few of those points as we go. Gary, just advance the slide for me. Thank you. There's probably nothing on this slide that you guys don't already know. This is a time in the market where we've got a really hot equity market. Commodities are hot as well. And there is a fair few things that happen in this sweet spot of the market which can't really happen in other stages of the mining boom. So that's one of the characteristic things that we look for. It's what tells us that the cycle is mature, but it's also the thing that tells us that we're about to see some pretty impressive performance from the juniors. And one of the things that really contributes to that at this stage is that the rubber, if you like, of growth ambitions of the industry really start to hit the road. And I've got quite a bit to say about growth in the mining cycle as we go. One more slide, please, Gary. What I'd start with, though, is let's just talk about the equity market. I said it's running super hot. We're in Australia. The broad Australian index, the All Ordinaries, it's had a really, really good performance over 5 years. So if you had $1 in the market in January 2016, you'd be sitting there with a bit over $1.50. So more than 50% return. That's a fantastic return for that period of time. Now, I'm picking January 16 as my starting point because that's when the mining boom kicked off. So it's as good a starter point as anything to make these comparisons. And in March last year, we had the COVID crash, if you like, in March 2020. Since then, the Australian market is up 67%. So it's interesting that in that short 18 months or so, it's crammed more performance into that than it had in the entire 5 years to now. Worth just keeping that at the back of your mind as we go. But we're talking about miners today. The Australian Large Capitalisation Resources Index, the ASX 100 Resources, is up 132%. So if you'd had $1 in that in January 16, you'd be sitting there with $2.30 now. So you're well over double your money. Interestingly, the performance for that index since the COVID crash hasn't been as good as the broader market. And it's a shade of what it was over the previous 5 years. I don't think that that's significant in terms of where we are in the cycle. I just think it's an interesting thing to point out. And look, if you really want a shooting star as to what's been super hot in the market, have a look at the NASDAQ out of the States. You've more than trebled your money in the same period of time since January 16. The COVID crash was almost not even a blip, and you've doubled your money since. And by doubling your money, I'm just not just talking about doubling a dollar there. That doubling or more of the NASDAQ created almost $10 trillion US of market capitalization. So it's certainly not a sniffing amount. And to quote Mark Duclair, I think it was from yesterday, I think the only thing you can say about that is shit. There's been quite a lot of money pour into that market there. Take me along another slide, please, Gary. So let's break down the mining sector a bit, because what I'm really interested in is what's been happening in this boom, and we know that value has been added. I've got a donut here which represents the ASX 100 Resources Index in January 16, and then the same donut for the end of September this year. And the first thing that strikes you there is it's well more than double. So that's what well more than doubling your money looks like. But I'm interested in where has the money gone, and I'm not worried about some little explorer. I'm thinking about where have the billions gone within these donuts. So breaking those down and color coding them, we know that the value has gone up. There's been a little bit of addition through companies graduating into that, and one or two dropping out. But how has it moved? Gary, if you just advance me one more slide. Thank you. So the big winner in that 5-year period has been iron ore. It's gone from about, I think it was 4% of the index to something like 17% of the index. It's increased the market cap of companies like FMG remarkably. And FMG in that period of time has been almost a 10-bagger. You don't get 10 baggers in that sort of period of time in the headline heavyweight indices. So I think it's remarkable that we've had that amount of money pour into there. Metals I've grouped together, base metals and a couple of others. They've been a winner there, although they're not a large part of the index, gone from about 2% to about 8% in that 5-year period. I think you can see the battery and new tech theme really showing up there. Gold has been a winner, and it's probably logical given the move in price that we've seen. It's gone from, I think it was about 4% to about 7% of the index. 7% to about 11% in that period of time. But interestingly, the growth in the portion of the index was not from Newcrest's growth. It has been from companies like Evolution and Northern Star growing their way into the ASX 100. So Newcrest has sort of had its pocket picked a bit there in terms of its market share by those two companies. And possibly unsurprisingly, just as an example to separate the two there, Evolution is a company which is about 1/3 the market capitalisation of Newcrest, but pays about 85% of the dividend. So it's unsurprisable they've grown into that space. And I think this audience knows Northern Star quite well from that period of time. The biggest loser we've seen here has been energy. And of the energy stocks, it's mainly gas and oil, which are in this index, which is a little bit surprising in that gas is trading at very, very close to record prices in the net consumer economies there. It's gone from about 33% of the index to something like 17%. So, that strikes me as being a little bit of an anomaly there. The commodity prices haven't been poor, yet the portion of the index that they take up is not so great. And I think there's probably a sense of wokeness sneaking in there. We are all very well aware of the fossil fuel perceptions and what those things are doing in the capital markets. And I think we can see some evidence of that here. Interestingly, we've got BHP and Rio Tinto as the two largest companies in this breakdown, and they're diversified miners. We haven't really seen their share of the index change remarkably in that 5-year period, and that's despite them having these huge iron ore businesses. I think that's probably very strongly offset by what I was just talking about, energy. They had or have some large coal businesses, had or have some large oil and gas businesses. So perhaps that's worked against them there in the way that iron ore has worked for them. And look, I suppose the ESG side of things probably creeps in there too, in that if you blow up sensitive areas in the Pilbara, it's something which investors are caused to think twice about before they start putting their money into you versus somebody else. Let's go one more slide, please, Gary. So this boom to date, if we just put some lines to it, I'm showing you the ASX 100 resources, which is the bigs. That's what we've just seen on the previous slide. And I've overlain on that in red the small resources index. And the reason for that is I'm really interested to see how the smalls perform versus the bigs, because it's generally diagnostic as to how the boom is going. And this is the first place where we see the really unconventional factor of this boom creeping in. And that is that the small resources index has been outperformed, well, over this 5-year period, it's outperforming the ASX 100 resources by 40 percentage points, which is an enormous gap for any time. So that's anomalous all on its own. But it's had gaps of a similar nature at least twice up until this point. So I think that's worth unpacking. And I think you just need to reflect on what the small resources index has been made up of over that period of time and how commodities have moved. This is the first boom, I think, probably in recent memory, but perhaps forever, that has started with a circa 30% movement in the gold price. Now, the Small Resources Index is packed with gold companies, or certainly was in January 2016. And this movement in the gold price affected them, but it also affected a whole host of juniors which sit below those indices. And having that strong commodity price movement enabled an infusion, if you like, of investor money, a lot of it institutional, into companies which would often have to wait years to see that and sit behind the majors to receive that attention. So this boom got off to a really interesting start for that reason. And that was the first outperformance. Interestingly, gold has had another massive session, which was that 2018 through to about 2020. And gold went up 75% in that movement, as opposed to 30, which it did in 2016. Yet you don't see that movement reflected in the Small Resources Index. And I think there's a couple of reasons for that. The first one is that movement in gold equities in 2016 was amplified by some of the higher cost producers fixing their cost profiles at the same time as their revenue numbers were going up. So companies like St. Barbara and Resolute were getting 8 to 12 times multiples in short periods of time. And you also had the Northern Stars and the Evolutions, which was still in the Small Resources Index at that time, performing strongly. You didn't have that leverage effect, and you'd lost Northern Star and Evolution to the large cap index largely by the time that second movement in gold came. So you don't see it reflected nearly as hard in the Small Resources Index. And the second big thing which has happened in that period of time has been the nature of things like lithium, and lithium in particular, which has become a fairly mainstream commodity, if you like. It was something which was very poorly understood by the market in times like 2015. And here we are at a conference, and there's, I haven't counted, maybe it's 5 or 6 companies which are lithium exposed and focused, presenting to this audience. So it's become mainstream. And I think that is very significant in this market. If you cast your mind back to pre the GFC, one of the things which really inflated the value of mining equities was things like the price of iron ore. And there was many juniors working in that space as well as the majors. So it spread the performance out across the market. Iron ore has always been a majors game, and it's worked out that way. Lithium is a tiny market, which the majors will not be able to get invested in a really significant sense for quite some time. So it's quarantined the performance, if you like, into the Small Resources Index here. And I think that's responsible not just for the outperformance that we saw in 2018, which is on this slide, but also where we sit right now, which is lithium is with some very significant companies in that index, inflating that and giving us this outperformance that we see at the moment. Can I go one more slide, please, Gary? Thanks very much. So this is the same chart, and all I'm annotating on here is the times that the lion clock has been at as we've gone through there. And it's not a reconciliation of whether we were right or wrong. It's more just to talk about how the characteristic of the market has shifted in that period of time. So in 2016, we saw mining equities start to head in a positive direction. And in fact, at that point was when we saw mining equities start to outperform the rest of the market. That's significant. Positive performances, but also an outperformance is one of the things that you start to see in booms. And it was very strong at that period of time. Later that year, we saw the IPO market reopen for explorers, and we saw a market uptick in the number of companies that started listing in 16 going into 17. 2017, we saw the exploration trends all start to tick upwards. 2019, we saw liquidity come in and start to revive more and more of the juniors. And then in 2020, we started to see things like people from larger companies moving into smaller companies and seeking maybe short careers, but very well rewarded ones. And that you've got to be careful with something like people moving around the industry being diagnostic. But when you start to see a number of them, it is something which does happen and is a signal of moving into some of the more mature points in the cycle. So we started to see that. And then, of course, in 2020, we had the COVID crash, which is the kind of thing which, you know, really quite honestly should have taken away Peter Costello's punch bowl. But instead what it did was it spiked it and turned the volume right up. So we went from we had a share market boom off the tail end of that. And it created a year in 2021, which has almost been a year of two halves. It's the kind of thing that the coach's cliche of a game of two halves. 2021 has been a lot like that. In that we've had this enormous surge of liquidity, which has very much been provoked by stimulus and a recovery from the COVID crash. but has then led to somewhat of a softening. And what we can see on this slide, which is the last thing I would say before I move on, and I'll talk about 11 o'clock a little bit more as we go, we can see a significant softening there of the ASX 100 resources index, which hasn't been mirrored in the small resources. I think there's a very good reason for that. It's lithium. But the softening there is the first time that we've seen, first of all, a circa 20% fall in the headline index, but also an underperformance against the rest of the market, which is it's significant. I don't think it's something we should worry about, but it is the first time that has happened. So I think we're starting to see, pretty good evidence of volatility as we get into let's call it a clunky economic recovery following what happened with COVID. So let's move one along, please, Gary. And there's perhaps a clue in this slide as to what has softened our mining equities. I've selected a bunch of commodities which are, I think, topical to this crowd. I've ignored some of the energy ones, not because I'm getting wokey on you. It's just that I think gold, iron ore, copper, and lithium are certainly the ones that we're wanting to talk about in this room. And there's a number of performances here which have contributed to the boom in interesting ways. Gary, I can't quite see. There might be. Actually, we'll stick with where we are for now. One thing which stands out on these slides is that the COVID crash. Thank you very much. Gary's just zooming me in there so I can see a lot better. The COVID crash was a turning point in many of these markets. You can see the blip in gold. You can see the turning point in copper, and I think that's one thing which is worth pointing out on here. I spoke already about the gold price spikes that we saw in 2016 and really helped to get this boom started. But I think whilst we're on this, one of the most unusual things about this boom has been this huge movement that we've seen in iron ore, not just up, but then down. Since mid-2020, we've seen iron ore go almost treble in price and then almost halve in the last 3 or 4 months, which is a type of volatility that we've not seen in iron ore ever. It's been one of the most stable commodity markets until about 2005. As the price started to float, this volatility creeps in. But even then, this is an enormous move. And I think to explain that, you've got to say, well, iron ore is a monopoly almost in terms of supply. There's Australia plus or minus Brazil. And it's a monopsony in terms of demand, which is that a lot of it goes to China. And China at the moment is grappling with a mandate to burn less coal. It's grappling with the effect that has on the power demands of its economy. And there's 1.4 billion people who are going to be shivering through their winter, questioning their party loyalty. Yet we see these very determined moves from a very well-organised buyer reflected in the iron ore market. So I think that has softened the major equities very significantly. It's hard to forecast earnings when you see those kinds of moves. And before I move on, I mentioned the lithium price already, but here you can see lithium going 4.5 times since early 2021 or late 2020. And I think with that kind of volatility, you really, really have to take your hats off to the guys who have built lithium mines in the last 4 or 5 years. I mean, you think about the gold market and that kind of volatility. It first of all, probably a little bit easier to predict in gold. You can forward sell it. And here you have lithium, which has gone from windfall to near death back to windfall again for those guys. I got to tell you, I think the diggers and dealers people, when they're giving awards to best miners, don't have any regard for how difficult the underlying commodity can be and the challenges that these companies have had to face. So hats off to those guys. I think what you've done is a lot harder than building a gold mine in Africa for mine, absolutely. So let's move on from commodities. So Gary, if you'll advance the slide for me, please. Whilst we're talking about really weird things which are happening, I just couldn't help. Costello mentioned the footy, so I'm going to as well. Everyone in Melbourne is absolutely reeling at the moment, and it's not from months of lockdown. It's that the Demons actually managed to win a premiership. I don't think anyone saw that coming for quite some time. But whilst I'm at it and whilst I'm talking to you, Perth, I would really like an explanation for these two fellas on the left here. We've got Max Gawn, captain of Melbourne, lifting the cup. And you've got two alleged fans of the team that got beat by 10 or 11 goals who are, they look almost as excited as if they're Melbourne fans. So I don't know if they stole the scarves, but wouldn't mind some information on that when someone's got a moment, please. Let's move on, though. Gary, one more slide, please, because we're talking about very unusual things which happen in this boom. And to me, this is one of the biggest ones. What I'm showing you here is the dividend yield of the ASX 200 index. That's got everything in it on the Australian market. It's not sector specific. And its yield has, well, it's fallen in the last 3 or 4 years. And then we've got the materials index, which is absolutely stuffed with resources companies superimposed on that. I felt that it was important to put on when the mining busts were here, because what you can see when you do that is that typically the yields of resources sector decline through the boom periods. Yet here we are in a boom and it's going really well, and we've seen the yields of the resources sector increasing through this. So this is a really unusual phenomenon as far as the history of markets go. And I think there's probably some pretty good explanations for it. Miners are pushing out great dividends. BHP and Rio declared absolute record dividends in the last 12 months. So, it stands to reason that it should be yielding. But the material sector here is outperforming the rest of the market. I find that interesting all on its own. Miners have had windfall events in the past, but it hasn't made them yield plays. Yet here we are, and they do seem to be looking like yield plays. So there's got to be an explanation for that. I think you can probably read into this that the market can afford to pay a lot more for miners than it currently is, particularly given the way that you can see how much it's apparently paying for the yield in the rest of the market. And if I was to address that, and I'll give you one data point to start with, in mid-2008, BHP was trading on about an 8 times multiple to its EBITDA. So the market was paying 8 times earnings. It's sitting at about 5.3 mid this year. And that was before the iron ore collapse. So I think there's definitely headroom there to be paying a lot more for miners in this market. But what's the reason why it's not? And I'd like to dig into that a little bit more. So Gary, if you'd take me to the next slide, please. My hypothesis, and I'm very happy to stick to this for now, is that the market's willingness to increase what it pays for miners is tied very strongly to the growth outlook. And I think the growth outlook ties very strongly to that dividend yield and what the dividends are being paid. Now, I think the dividends are wonderful things, and I think it's a very financially responsible thing for the miners to be doing. So I'm not suggesting that they should change their behaviour, but let's look at what's happening in terms of growth in the mining space. There's definitely growth-oriented thinking. That's happening, and we can see companies thinking about how they're going to make themselves bigger and grow their market share. There's definitely commodity price stimuli. Softened a bit recently, but it's definitely there, and I think those things are uptrending. And there's an uber-supportive equity market. So you do something good in mining, you get rewarded for it. I think that's in place as well. But then when it comes to growth, you've probably got the market looking at miners going, you're pushing out all of these dividends, guys. What are you spending on growth? Historically, you haven't been able to pay those dividends because you've been so dead set on investing it, reinvesting it in the industry that you're in. And I think that's where we're at loggerheads there. And it's not to suggest that I think that miners should be acting in a hostile or irresponsible way, but I think that that's what's missing. So if that more aggressive attitude to growth were to start to creep into the mining space, then I think you might start to see the premiums that are paid for miners creeping up a bit. And given that we're at 11 o'clock, this is exactly the stage in the market where you start to see that happening. The other thing which I would say is an overlay on this, and it speaks very much to M&A, is that we've had a softening in the mining market. And any softening that doesn't turn into a crash, and this one hasn't, is going to be a buying opportunity. So you think of the M&A inclined companies and you think of what they might be thinking. Well, if you've got cash in your pocket and the market's softened, that's a buying opportunity for you. One more slide, please, Gary. Let me give you a worked example here, and this is from the ASX Gold Index. CapEx trends have not been matching other trends that you typically see through the cycle, right? So things like exploration trending up, CapEx trends have not been. And granted, we haven't seen things like the construction of enormous new gas hubs or new iron ore railways and things like that to really push a lot of CapEx in there. But it's been flatlining. So this is obviously maintenance stuff rather than really aggressive expansion. I think everybody understands that. Here's an example from history then. The last 20 years worth of operating and investing cash flows from the Australian Gold Index, and the companies come and go, but you can see how cash flows ebb and flow from year to year. And what I'm trying to point out from having the gold price chart here is that once you've had an episode of windfall prices, you get an investment binge off of the back of it, and you get these investment cash flows, which are the ones below the line, starting to blow out. And I think we're starting to see that again. I can see the CapEx coming here. So 2020 was a big year for CapEx in this index. You can put some of that down to companies buying the super pit, but not all of it. And we've just seen companies like Newcrest talk about the enormous capex which they're estimating for 3 or 4 projects, some of which are going to be major expansions within their portfolios. They're not Robinson Crusoe, nor is that going to be $2021, but there is capex coming down the pipe there. And I think this companies expanding their production and investing in their assets is going to start to excite people. So this is one example I thought I'd give. Next slide, please, Gary. Talking about money pushing its way then into resource opportunities, you can't talk about that without talking about IPOs. And this is the absolute bellwether of liquidity. Is it there or is it not? Well, look at the IPO trend and that will tell you. And we're going back some time here. Each mining boom we've had has been punctuated by a growing amount of IPOs coming through and listing. And most of those are exploration companies, right? But as you get to the peaks of cycles, and this is one thing which shows you that liquidity is high, you cannot have large listings of new companies in the mining space without there existing a very high level of liquidity. It's got to be there to support it. In previous cycles, we've seen some of the largest listings coming in the years, might be even the 2 or 3 years leading up, which is what tells me that I think we're moving into 11 o'clock, but there's room for this to go on for some time. We have just seen in Australia the largest listing for 10 years, $500 and something million raised in order to facilitate the listing of a new copper miner. Well, it's not a new copper miner, but it's new to ASX. The Canadian market has just welcomed its largest listing for 9 years in the mining space. So these two things coinciding in 2021 tells me there's a fair bit of money around to list new businesses, and listing a new business means that there's no track record. So for investors to value it, they need to think that they're getting a bargain on the day and they've got to hold it, which is what brings it to market. So there's a trend underway there, and I think that this is the most telling thing that's exactly what we're getting to. Next slide, please, Gary. And I feel like the timing's going quite well here. I usually have to rush my last few slides, but I think I'm on my last 2. So what are we on the lookout here for? What is it that's going to tell us how we're going with 11 o'clock in the market? And I apologize for some of the icons here. The exploration one, if you go into Microsoft icons and go search for exploration, it gives you that. And then for M&A, it gives you the one bottom left. I'll explain that in a second. In exploration, I'm looking for continued exploration spend, but as you get growing and ongoing exploration spend, you get discoveries and you get resources growing. And that'll be very positive for the equities of the people that own those things. And we've seen a number of examples of absolute explosions of share market growth and capital generation from discoveries in this market. So I think that we'll keep watching that. But exploration doesn't drive the cycle. It's a symptom of it. And exploration is not going to crash the cycle either. M&A is a good one. I think we have some very cashed up acquirers. We've got them probably seeing what we've got in the equity market now as buying opportunities. And like I said, I think the market as a whole can afford to pay a whole lot more for the mining sector, particularly if it starts to show that it's got growth ambitions. You think about it, if you're a gold company and you're trying to tell people you should buy my company over others, tell them the gold price is going up. They'll make their own mind up about that. And after all, it's out of your control, all right? The company can't make the gold price go up, but it can show that it's going to grow its profile. And that's the thing that investors get really excited about. So I think when that starts to happen, either by M&A or aggressive CapEx spend, is one of the things that a lot of investors are going to sit up and take notice of. We've also got operating cost inflation. And, you know, you look at some of the sectors which are quite prominent at the moment. Gold is one. Op costs have crept up over the last 5 or 6 years. And this is one thing which in previous cycles has been an incentive for companies to start to look in more risky jurisdictions as a way that they can make an acquisition and start to reduce their operating cost profile. So I'm wondering if that's going to be a factor of what we start to see in M&A, particularly as the world opens up. China, well, who knows? They're a very coordinated buyer. We've seen, I think, their centrally mandated behaviours have a big effect on iron ore, and it wouldn't surprise me if there's more volatility to come from that, but it's very difficult to predict. There's a big middle class there which has developed expectations. So the party is going to have to be quite careful about exactly what it mandates, but I think we're going to have to watch with interest rather than predict that one confidently. And then finally, COVID. I don't think we're out of surprises yet as far as COVID goes. We're having a clunky recovery, and I think that has been affecting commodity prices. So it's something to really keep an eye on there. Take me to the last slide, please, would you, Gary? So I always finish with this one. I spoke about what the evolution of the times had been earlier, and here we sit at 11 o'clock. And that's not far in terms of just how the clock moves from the top of the cycle. But I would hasten to add that 11 o'clock in previous cycles has gone on for years. I think we're at the start, not the end of 11 o'clock. The liquidity is showing us that we're there. But when that liquidity creeps in, it typically inflates the value of some of the bigger miners. It washes down into the juniors. You start to see the explorers and the juniors really thrive. We've got that going on despite having a bit of a softening in liquidity at the moment. And like I said, because the market can afford to pay a lot more for miners than it is at the moment, I think that gives us a lot of comfort that there's a lot of room for that to start to happen there. Something will take us to the top of this, and it's going to be very difficult to predict what that will be, because it's the excesses of a boom which cause a crash. It's not really the catalyst which tips us over the edge when we get there. But I think it's just really important to remember that every single mining boom that we've ever been in has come to an end. And the thing that's about it that's been most hard to predict is when that will be, because often the closer you get to the end of it, the more you feel like it's going to go on forever. Anyway, that's enough from me. I've got to get to Dan Murphy's this afternoon, so I'm going to have to leave you guys all to it. But it's been a real pleasure to talk to this conference again. Thank you so much to Paul, Sharon, and Nick for inviting me along, and also for all of you for listening. So all the very best. Hope you enjoy the rest of it, and I'm going to tune in, particularly for some of the discussions this afternoon, which are going to deal with the things that I'm far less of an expert on, things like lithium. So good luck to all of you.